Does your portfolio look like this? Are you consistently underperforming the S&P 500? Do your parents call you stupid? Are you buying dips that keep dipping? It's probably because you suck at investing. Reason number 1, you won't even start. A lot of you probably heard or even think investing $100 won't make a difference. And to an extent, that's true. If you invest $100 once and you're expecting to buy yachts and Lambos, your parents aren't wrong. They probably are stupid. These are the same people who will sign up for the gym on January 1st.
Still look the same. It's January 9th and I don't have it yet. Maybe next year.
Investing isn't about the one-time big hit. It's about the consistent monthly drip. That time turns into a flood. She's got to be wet before she squirts. You know what I mean? Reason number 2, you don't have a plan. If we go back to the gym analogy, you show up to a gym without a workout plan. You start your workout with 10 sets of thank yous.
Thank you, thank you, thank you.
Another 20 sets of yapping. What the fuck? And you finish your workout with 20 sets of spreading the love. So what do we get? An inefficient workout, aka wasting 2 hours of your day. And since time is money, you just wasted money. That's why your parents call you stupid. In investing, just like the gym, you need a plan. So ask yourself 2 very important questions. When do you need this money? And how much money are you willing to lose? / risk tolerance. Look at me. Woo. On the x-axis, time. More time for your money to grow? I need it when I'm 60 years old. I need the money next year. I need the money tomorrow. The upsies and downsies, risk tolerance. I am willing to lose a lot of money here. Or I don't want to lose any money at all. You got not a lot of time, but a high risk tolerance. Buy lottery tickets, You'll be investing a lot in options, speculative trading, and high yield bonds. You could lose a lot of money here, but if you have a low risk tolerance and a low time frame, you're kind of cucked. You'll be holding more cash equivalents, something like a savings account, money market funds, short-term government bonds. Dog shit money, bro. I'll be honest. You're making like nothing. And now we're over here. You have hella time. I'm gonna retire in like 50 years. This is where you want to buy diversified blue chip stock. Your Coca-Colas, Waste Management, Microsoft, shit like that. Investment grade corporate bonds. It's fuck the government. We gotta just, companies, real estate. I'm gonna buy a house and sell it for $10 million in 60 years. All the goddamn boomers who bought the houses for $50 and now they're selling for $1 million. Look at that. Crazy. Index funds. The best shit ever. Now you got a lot of time and a high risk tolerance. You want to be investing in more growth stocks, emerging markets, and venture capital. Early Facebook, Uber, Cook, new technology right now. AI.
White Iverson.
Technology. Biotechnology. Amazing stuff. Reason number 3, the most contagious virus in the market. FOMO, or emotional trading. Fuck! Your friend sends you a text. Yo, you gotta buy this game stock. The stock is going crazy, bro. I just doubled my money. You see news headlines. CNN's reporting. Fuck! People are making gains like crazy. So obviously you can't be left out like you were in high school, bitch. So you buy at the top thinking this investment will go up forever. And you get left holding the bag. Rule of thumb. If someone you know who doesn't talk about stocks, like your grandma, your neighbor, your Uber driver, and they're talking about the same stock, I hate to break it to you, it's probably too late. You're likely to be exit liquidity. Fucking chill. Now logically, the next step after FOMO is blindly following hype. Think about it. You don't have a strategy, but you feel the greed. So you let someone else do the work for you. The problem is, you have no idea what you just bought. That's like you just bought a mystery box. And it's a fucking teddy bear.
Smoking the Zaza, they go straight to the Mata, then I'm up in the chopper,
You're scrolling Reddit, TikTok, Twitter, and you see a stock symbol trending. Hop in its pussy, bro. It has an awesome story. It promises to stick it to the big guys, like Bitcoin. Here's the issue. You confused a great narrative with a good investment. Here's the thing, a good narrative can drive a stock in the short term, but a company's fundamentals are what drive it in the long term. Here's the gut check. If the stock drops 20% tomorrow, can you honestly defend why you bought the company? Can you explain to a coworker why you're such a disappointment to your family? Can you honestly explain to a coworker why you bought the stock without mentioning TikTok or a Reddit forum? If you can't, well, you don't own a business, you just own a hot potato. Sell that shit now. Reason number 5, lack of financial math skills. This is gonna be crazy, bro. But you remember those kids in school when you say math is useless? I'm never gonna use that shit in my life. Well, here they are making these very common mistakes. The share count bias. You think a $5 stock is cheap, and a $500 stock is, well, that's too expensive. Oh, I'd rather have 100 eggs at $5 than 1 egg for $500. But you're ignoring the fact that those 100 eggs are turtle eggs, and half of them will be eaten before they even reach the sea, and the other half died of fucking plastic. What the fuck? Friendly reminder. Oh shit, while the $500 egg is actually an ostrich egg with a supreme sponsorship that generates a new egg every year that's slightly better than the previous year's egg. You need to look at market cap, outstanding shares, not just the share price. The share price is irrelevant without it. Now, the second common mistake, which is usually for more intermediate investors, you want to build a compounding dividend portfolio that snowballs into bigger and bigger dividend payments. You only look at the dividend yield that the company is paying and ignore everything else. That's what's called a high yield trap. If your stock pays you a 20% yield, but it drops 25%, you didn't make 20%, you lost 5% overall. It's like collecting $20 of rent from a house that lost $25 in value.
What's up? Hey, what are you doing? That's 25 crowns dollar, whatever. Unbelievable.
You're losing principal to chase income. A lot of high yield max investors over here. Look at this. What? 100. It's like over 100% dividend yield. We're like losing 90%. Fuck. Reason number 6. Number 6. The market timing martyr. Buy low, sell high. Sounds easy enough, right? I'll just wait for the stock market to crash and I'll buy it at the bottom. Look at that. Simple. Let me set the scene. Trump announces he's gonna drop some tariffs. Market doesn't like that. Sell-off starts to happen. You don't buy. You're waiting. You're waiting. The market recovers a little bit. April 2nd comes around. Tariffs for sure. What the fuck are these? What the fuck? The market goes down even further, but you haven't bought yet because you're expecting the market to drop even further, even though it's already down 30%. But you wait. Now you're waiting. The market's recovering. A week after that, the market's still recovering. It's going up. Fuck. You haven't bought any stocks because you expected to go down even further. So you haven't bought. You're still waiting. Now, 3 months later, the market's already recovered fully. And we're even at all-time high. But you still haven't bought. A wise man once said, time in the market beats
the Jet2 holiday. And right now, you can save £50.
Time in the market beats timing the market. You can't time the bottom. At least not consistently. Reason I'm losing track. Next one, over trading. Oh, look everybody. It's every brokerage's favorite customer, the overtrader. You day trade, swing trade, your favorite stocks, often making small gains frequent, but you ignore the overall picture. The vast majority of your gains are eaten by transaction fees and capital gains taxes. Just buy good companies and hold. Shit. Reason number 8, lack of diversification. Your favorite stock or coin is the greatest stock or coin of all time, so you make it 90% of your portfolio, and when it's doing good, it's doing good. But one bad financial quarter or one bad news cycle, boom, your portfolio is in the shitter. It's like building a 100-story apartment complex where 90% of the building is held up by one singular pillar. Sure, that pillar might be great, might be the greatest pillar ever, but one soil shift or one earthquake and you don't just have a loss, it's a catastrophe. Reason, the next one, paper hands, the market drops 10%. This is when most real investors see an opportunity to buy assets on sale. You, however, see a giant red flag. You panic. You sell everything to save the remaining 90% of your money. You realize 2 weeks later that the market's already recovered and moved even higher. Congrats, bro. You officially locked in your losses and missed the recovery. You're emotionally fragile, and the market knows it. You're the one supplying cheap shares to the people who actually make money. Don't let short-term volatility derail your long-term plans, if you even have one. The anchoring bias. Oh, you buy a stock at $100, drops to $50. You refuse to buy more because you bought the stock at $100, but you also refuse to sell the stock at a loss. So you hold the stock, hoping it'll break even. It climbs back to $90. You buy another share or two. Not when it was at $50, but you bought it when it's at $90, hoping it will break past $100. Then it drops again. Then it drops even further. And eventually the company goes bankrupt and you lose your entire investment. Too stubborn to sell. Anchoring bias part 2. This works in reverse. Picture this. Some people look at a stock and say, it's too expensive. I could have bought it cheaper a year ago. So you end up not buying the stock. 1 year later, the stock is now up another 50%. And well, you can't buy it now because you could have bought the stock last year at a cheaper price. So you end up not buying the stock. And well, shit, repeat. The stock goes up another X%. 4 messages. Don't anchor your buying decisions to a price you missed in the past. You have to anchor it to the business's current value or future value if you're investing for the future. The last one, confirmation bias. You're a proud owner of whatever. You spend all your time reading articles, watching videos, and scrolling forums that only agree with your position. I think this is a good company because I said so. You avoid any information, no matter how factual, that suggests that your investment might have problems. You're living in an echo chamber, protected. It's not research, it's self-soothing.
Always right. It's like when I'm right, I'm right. And when I'm wrong, I could have been right. So I'm still right because I could have been wrong.
If you can't look at the bear case, you're not an investor for cheerleadership. You're just glazing a company. Well, let's go Tesla, the greatest company ever. They are barely profitable. Anyways, that's all the reasons why you suck at investing. I'm not projecting. These are your issues and not mine.
Thank you. Thank you. Thank you.